Hey, what's going on, everybody? Today, we are talking about why it is a market of stocks and not the stock market. This is Wealth Defense Radio. I'm your host, Josh Nahosa, and I'm an independent advisor representative. And I am here with a certified financial planner, and his name is Hector and Nahosa. That is the top mark in our industry, and in the original Greek means has trouble taking notes.
Smartest person in the world that has trouble taking notes.
Yes.
Welcome. Thank you. Thank you for joining us.
Hector has been doing this since the early 90s, and Swan DFW now is 12 years old, 13 years old, 10 years old.
12, 14, 11 years old. We'll be 12 years old in January.
12 years old in January.
Yeah.
So-
Long time. Happened fast.
There you go.
I started when there was no laptop computers. We had abacuses. We would run all of
Sundial.
our... Yeah.
There was no clocks.
Yeah.
How did the person who invented the first clock know what time it was?
That's a really great question. How do we know what time it is? How do we decide today is Tuesday?
Yeah, all of these are questions that I think about.
January 1. How did that happen?
I guess if you all know, comment down below.
Yeah.
We have a couple different ways that you can contact us. We have a phone number, we have an email address. All of those will be in the description wherever it is you're watching or listening. Let's jump right in now that we've thought about clocks for long enough.
Yeah, time.
Stocks, stock market. We started last episode. It's a great watch. Maybe you can pause this podcast and watch last week's to get the first part of it. But why don't you explain where this came from?
If you go back and do that, we'll be talking about how because of our economic system has changed, so have the stocks or companies that are the drivers in our economy. This started because one of our clients read an article about the stock market and how it was overpriced, and the world was ending, and everybody should get out of it. And so what we're going to talk about today is why what the market is today, which is a market of stocks instead of the stock market, which is what most people kind of track, and why it's important to know that, and then what the difference is and why it may be advantageous for you. If you had a group of, let's say, 10 sprinters and their average time in the 100 was 10 seconds, you'd say that was not bad. But if you had one guy that was running at 9:1 world record pace, you'd probably want to, if you were a coach, you'd probably want to focus on that one guy and not trying to bring all 10 to do better. You could, but really, your focus is going to be on that one guy that's running faster than everybody else. The same thing in when we go to a market of stocks is we're finding the individual stocks that are better positioned in the market to take advantage of what's happening in the marketplace, that have a lot of cash, have all the deliverables. I'm thinking particularly, and again, this is not an actionable thing, but you look at a stock like Apple, which is best in class. They've got a tremendous number of clients in a great industry, and they've taught us that if your phone is 5 years old, it's ancient. Even if it's still working and does every single thing, it's time to turn it in. That is like, we don't do that with washing machines or lawnmowers, but Apple has taught us. And so instead of the other 499 stocks in the S&P 500, this particular stock is going to, in my opinion, be a stock that you may want to consider owning because it's well positioned and all the other things we just talked about. So that's the difference between a stock market and a market of stock. The individual stock is really way more important, in my opinion, than what the market as a whole might be telling you.
you can buy like an S&P 500 fund and like a NASDAQ fund, but you're not buying every single stock that's ever been offered ever and that's currently available to be traded, because that's just not an efficient way to do things.
Right.
So we're saying take your top 4 or 5. The rest of the stock market, well, it matters some. It doesn't matter as much as the top ones that you're invested in.
A really good example right now is healthcare. The healthcare long term is going to be really good, but right now, healthcare has been the worst performing segment in the 500 stocks, and so that's going to drag the whole market down. But obviously, a technology company, is not going to be in healthcare, and so you just need to understand the difference between the individual stocks and the market as a whole.
Yeah, let's talk on to there's wide variation in the market that kind of can go into segments as well. But why don't you talk about that?
You know, when we were in the middle of the pandemic, healthcare stocks went sky high because especially drug making stocks. Everybody was hoping somebody would come with a drug and stop the death and the suffering. So they come in cycles. And so, a company that's in one segment, in that segment, retail, as an example, might be really doing really, really well, but another segment like healthcare or technology or foods. And so all of the segments as a whole is a good way to track the whole economy and what we're thinking and what investors are thinking. But as you're thinking about individually investing, once you pick the sector you think is good, then to find the best performer in that sector is probably a good thing to do.
Yeah, but we are not saying throw all of your eggs in one basket.
Never.
You don't want everything in just one sector or whatever, because diversification is still an important part of the puzzle.
That's right. And so, you may be in a high-flying sector today, and you're, getting returns, a pretty high return in that sector, but things are cyclical, and, moods will change, and what is needed in the marketplace will change. And so you may see healthcare come back. You may see manufacturing, and I'm thinking in terms of cars and stuff, come back. You may see. It's been real interesting to see how housing has done, even as interest rates are higher. So each one of these sectors might be a good place to have a position in. Just know that sector is going to drive usually that particular holding, but it might be. It's definitely good to be diversified. Putting all your eggs in one basket is not a good thing.
Yeah. Let's talk about the indexes, because they are just basically an index is just an average. And if you have more questions about what is an index, what is the S&P 500, again, last week's episode would be a great episode for you to watch, because we answer all of those questions. But we're going to assume that you have a passing knowledge on that as we talk about it here. So indexes are just merely kind of the average of the stocks that are within that index.
Yeah, and again, the average of 500 companies and how they're moving may or may not indicate how your individual position in a particular company will be moving. But it is, we need a benchmark. We need something to look at. But when you read an article about the market as a whole and trying to make an investment decision based on what the market is telling us, maybe we need to discuss that a little further. Maybe really good advice. It may not be. So don't pull the trigger on something that you read anywhere or hear anything on the radio or on TV and stuff. That's why a financial advisor is a really good thing. Let's walk through what your goals are. Let's make sure that we got your portfolio diversified in a way that makes the most sense for you and what your goals are.
Yeah, I guess lastly here, let's talk about market sentiment versus fundamentals. Maybe for those that aren't as well versed in terminology, why don't you, in 2 or 3 sentences, say what market sentiment is?
One of the things that the market's always trying to figure out is how we, as average people living, how we feel about our future, the future of our economy, because that's going to drive our individual decisions, which will drive the economy, but more importantly, might drive a particular stock or a particular sector. As an example, if I just got a new job or if I just got a promotion in my new job and I'm making more money and I feel like this is a company I'm going to be with for a long time, I may think in terms of buying bigger ticket items. You know what? I think it's time we move into a bigger house. That's a huge purchase because along with the house, you have all kinds of other things you have to buy, new furniture, drapes, landscaping, all of that. That's a lot of people being employed just with your decision to do that. You're not going to do that unless you feel good about what's happening, or maybe a new car. Conversely, if I'm thinking about buying a new car and I'm seeing a bunch of layoffs at my company, I may be thinking, man, I don't want to take on any more debt right now, because if I do, what happens if I buy this brand new car and I have an $800 payment or whatever, and then I lose my job? So I'm not going to buy the new car. I'm going to spend a couple of $100s and fix up my current car. Well, that non-purchase obviously is going to hurt the car industry. They're hoping that they can induce you into buying a new car. And so just the way we feel about our futures is a sentiment that the market is looking for, is what's the end? At the end of the day, we're the ones who buy stuff, right? We're going to buy the laptops, we're going to buy the cars, we're going to buy the homes. How are we feeling about our future? Are we positive or negative or neutral about that? That's going to drive the way we do it, and that's going to drive a lot of the market, and that's where a lot of the market sentiment is. That's why these numbers that come out, the consumer price index and the jobs reports and all those things are people trying to figure out what's happening and how are people going to feel about what's happening. So that's the sentiment. Has nothing to do with our last topic.
With the fundamentals, which is like the balance sheets and how the company is actually doing. It's more of like a mathematical way to look at investing versus the sentiment is more of like a how do we feel about it.
That's right.
There is a balance of both that needs to happen, probably. But it can't be 100% one.
No, you're right. One of the best indicators of what market sentiment can do and have no regard for fundamentals was, again, the pandemic. When the sell-off started, when we really thought this was the end of the world and all of us were going to die and everything, almost every single investment dropped. The stock, the S&P 500 dropped 34%. Now, in 8 months, it was back to its highs, but when that sentiment became that negative and everybody was scared, it didn't matter that your company had more sales than it had ever had, and its balance sheet was awesome, and its cash position was great, and your management team had been together for 6 years, and you were looking down the road and saying, man, people are going to keep buying my product. None of that mattered because everybody was so scared that your fundamentals then, like I say, no matter what, everything was coming down. So understanding what the sentiment is useful, and I guess, but don't make an investment decision based on, because what happened to people, like in 2008 and during the pandemic and in 2020 and 2021, is that they were selling at the bottom. And when you sell at the bottom, you're scared enough, or you're going to stay out of the market. You're not going to invest again. And the biggest moves in the market come in those bear markets. And in the last 30 years, if you were out of the market for 10 days, the 10 best days of the market, your returns would have been cut in half just by being out 10 days in 30 years. So buy a good company and make sure the fundamentals are good, and then hold on to it.
Yeah, so this is more when you read something that says, hey, the stock market is bad things are happening. There's bad vibes. Whatever you read on whatever news website you decide to read, it's important to look at the stuff that you hold and your stocks, because you're not holding the entire stock market. if
That's right.
you're holding your stocks, which is what I think should be the main takeaway of this, is don't overreact to something that you read.
Yeah. And it would be really good. We sometimes diets force us to not eat foods we really like because it's better for us. I think we should take a diet from media. Financial media diets are probably really good because if you're reading everything that comes out, remember, many, including the CNBC and all those shows, their main business is not to give you information. Their main business is to sell commercials so they can say on the air. And to do that, to keep your eyeballs on, they can't. They make more money when they report bad news. So they're always going to be looking to talk about the bad news. And they want the eyeballs there so that people will buy commercials. And because some wise man once told me a long time ago, it's all about the money. And when they say it's not about the money, it's about the money.
So, if you have any questions about any of the things we talked about today, maybe your plan for retirement, maybe your investment holdings, maybe anything else, maybe it's college planning, maybe it's trying to figure out how am I going to take a vacation while I'm retired. We have a couple different ways that you can contact us because our actual real life job is not podcasters, believe it or not. We are retirement
People
planners.
would never believe it. We're so good at it.
Yeah. We have a couple different ways that you can contact us. Those will be on the screen and in the description, but our phone number is 888-792-6339. That's 888-SWAN-DFW. And we have an email address that's info@swandfw.net. Again, those will be in the description wherever it is you are watching or listening.
And the last thing for me, anyway, is always go back to your plan. What is your plan still viable? Is it still good? Then it doesn't really matter what the markets are doing. So, yeah, get a plan, get good stocks in that plan, and then stick to the plan.
There you go. So, thank you guys for watching.
Yeah, thank you.
We'll catch you on the next one.
Be blessed. Thank you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.